Another edition of On the Money with the Certified Financial Group right here on News 96.5 WDBO's Ask the Experts Weekend. Good morning, Oracle of Orlando, Joe. How are you today?
Good. Welcome back, by the way.
Oh, well, thank you. Not only do we have the Oracle of Orlando, Joe Bird here today, we have Gary Abley here as well. Gary, how are you?
Good morning. I'm doing terrific. No rain today, maybe.
Well, 20% chance.
Well, I'll take it.
And knowing everybody in Central Florida, that's a 20% chance for about 5 minutes at some points around Central Florida.
That's the way it works.
It's Florida.
That's the way it works. Yeah.
Well, so as long as it's not 60, 70 like it's been all week and raining every single day. But so with a gorgeous day outside, it's now time to get out there and get your honey-do list done that you've been neglecting all week. And in the meantime, I hope you sit back and help us. We'll help you get to that retirement finish line. Joe, what can the audience call you about today?
Gary and I are here to entertain any questions that you might have regarding your personal finances. As we say, we go through life trying some of this, trying some of that, wake up at 55 years old, look across the kitchen table to Loretta and say, Loretta, honey, well, we're only 10 years away from retirement, and we've got to have income when we retire. We got Social Security and these IRAs, these 401ks. How do we turn that into a stream of income so we can continue to enjoy the lifestyle that we've always dreamed of? And that's what Gary and I and the 11 other certified financial planner practitioners at CFG do day in and day out for a fee. But on Saturday morning, we are here absolutely free. So if you have any questions regarding your personal finances, as they revolve around questions about stocks and bonds and mutual funds and IRAs and 401ks, reverse mortgages, annuities, life insurance, all that and more, Gary and I are here to take your calls. And there's no call that, there's no question that might be a dumb question, because if you're thinking of it, there's probably 146 other people out there that are thinking of it. And you don't even need to use your real name. You can pretend you're somebody else. So pick up the phone and dial these magic numbers.
844-220-0965. 844-220-0965. We also have the text machine up and running as well, 21232. That is 21232. Well, let's have a most unique name contest today. Let's see how many. Let's see who comes up with. Yeah,
I like it.
Yeah, let's see what we got.
And by the way, we're also on Facebook.
And we are on Facebook, so if you want to watch Joe and his plaid shirt. Joe's wardrobe has significantly gotten a lot better ever since the video cameras have been turned on.
I do have collared shirts, by the way.
No, I never doubted you. I just say, radio.
You don't like that
wear T-shirts
that I used to come in here with?
Well, to each his own, but, I'm just saying.
Let's not get personal.
It got potted up a little bit there with the collar and he even did his hair. It's great. So now you can really see
Makeup.
See, why didn't I think of that?
They only see the back of your. I don't even know if they see the back of your head.
Well, that's okay. I don't want to be seen. I don't want to be seen.
So if you want to watch what's going on in this crazy studio this morning, go to Facebook, and you go to Facebook in the search engine, put Certified Financial Group, and you click in right in the studio and watch all this hilarity that we have going on, right, Gary? So we have some calls coming in. We have look at the calls piling up here. So let's get right to it.
Let's get their screens. That's where we're going to start off with today's conversation, like we always do. What is a flat or inverted yield curve, and what can it mean to investors?
All right, go slow there. Flat inverted yield curve.
Flat or inverted yield curve.
Flat or inverted.
That's right. So when we look at yield curves, what is a yield curve? First of all, we're looking at the difference between what 2-year treasuries yield typically and what a longer dated, say a 10-year treasury would yield. And normally, if you think about it, when you loan money to somebody and you're not going to be repaid for, say, 10 years, you're going to want more interest because of potential default risk and for interest rate risk. What happens if you've got your money tied up for 3% over 10 years and interest rates start going up? That's not going to do too well for your debt.
So that being said,
typically longer dated treasuries yield more than shorter.
Just like a CD. If you're going to buy a long-term CD, you want a higher interest rate. All right. So there we go.
And you can almost explain it just that way, because if you look at CD rates, you're not really being paid much to go out further. You can find a 1-year CD around 2%. You just drove by a bank that had that offer. And you go out to 5 years, you might be looking at maybe 3%, right? So anyway, when a yield curve inverts, it tends to be an indicator that an economic slowdown, possibly a recession, is going to happen.
Right.
So if we go back to 1956.
So let's talk about what we mean by invert. I understand what it means.
So an inversion means simply that the short-term rates now are yielding higher, yielding more interest than a longer dated. So the curve starts to flatten initially, and then it inverts. Or
Flips.
it flips.
Right.
Exactly. And that has typically been a precursor to the last 6 recessions we've had since 1956. Usually within about 24 months of an inverted yield curve, we go into a recession. And so you say, well, why is that important to investors? Well, it's important because when we go into recessions, typically corporate profits are lower, and then we have lower stock prices. And that actually is a wonderful thing for long-term investors.
You're buying more on the
because
cheap.
We're buying more on the cheap. So opportunities ahead. we looked, what Joe and I do daily is we're rebalancing client accounts as they become out of balance, either because equities have risen or because equities have fallen. Well, if they've fallen, we get to buy more shares of stock, mutual funds, equities, cheaper.
Exactly.
If they've risen, we've got to take the profits to keep back into that risk tolerance. So anyway, an inverted yield curve, we expect that could happen perhaps by December of this year, which might mean we'll see an economic slowdown in the next couple of years thereafter. And so that's great opportunity for investors because we'll have that opportunity to buy shares cheaper.
So keep your eyes and ears open,
That's
and
right.
we will keep you posted.
That's
That's why we're here.
Yep.
All right.
All right.
What do we have, Kyle?
Let's do it.
Let's
Want to
do
get to
it.
the phone lines
Let's
now?
do it. Yep.
Now we got them all lined up, screened up. All righty, let's start off today. John was the first one to call in today. John, you're up next with the Certified Financial Group here on WDBO.
Morning, John.
Good morning.
What's
morning.
up?
I'm trying to raise my credit score. My daughter's score has a high of 823 and a low of 809 for 12 months. My score is a high of 820 and a low of 783 with 5 scores in the 700s.
Okay.
She always... Hello?
Yes,
Yes,
go
we
ahead.
hear you.
Okay. She always pays her statement balance, never anymore. I pay my balances on the due date. Usually there's no balance from the statement balance, but I pay the whole thing off on the due date. The only thing is my hit is between the due date and the closing date, which
Okay.
is like 4 days.
Okay.
My question is, should I keep doing the same thing I'm doing, or should I start paying just the statement balance?
So your question is, how do you raise your credit score to equal your daughter's?
Well, yeah, I like you
competition here.
800.
Right.
Right.
All right. So your payment history is a critical part of your credit score, but it's not the only thing. And so what I'm looking at here, probably the amount of debt that you have relative to your income is probably a factor there.
I don't have any debt.
Well, okay. Then your daughters, there's something going on here.
Well,
What
and
do you
then
think?
the other issue could be depending on how many cards each of you have.
That's true.
For example, the amount of outstanding revolving credit that you have. A lot of folks will say, well, I don't understand why my credit score isn't as high as somebody else. I have 8 credit cards, and all of them, have 0 balances, or I pay them on time. Well, if you have 8 credit cards, and maybe you total those up to $60,000 as a revolving credit, that actually is going to hurt your credit because the exposure to the companies is a lot higher than somebody who only has, say, 10,000 or 15,000
Right.
outstanding. But honestly, John, any score really above 750, you're not going to be dinged when you go
Right.
in to buy a car or you go in to buy a house.
Well, that's why I have a lease coming up next year.
Yeah, and that,
Yeah.
again, your credit
You're in
score
good
is
shape.
just fine.
Yes.
I think you're worrying,
Unnecessarily.
unnecessarily. I think your credit score is fine. Don't worry about it. But if you want to call our office, we can send you, a link to a site that will talk about how to increase your credit scores
Yeah.
legitimately.
Yeah, Gary's right. Your chances are your outstanding or available credit
Right.
is high in proportion to your income. And your daughter's available
Well, I
credit.
have 3 cards that I use. The main one, I charge everything on.
Yeah, it's not the number of cards, it's the credit line that's
I know.
available on the card.
Yep.
Yep.
So I don't want a lot of credit.
Well, if you don't need it,
The one that I use the most, they've raised it like 3 times in the past couple of years.
I have 2 cards in my wallet. I have a Costco card because I have to get in, and I love Costco. And then I have one credit card I use for everything. It's one of these reward cards where you
Right.
get 2% cash back. So I think we tend to, you look at all of the issues with credit fraud and identity theft. To me, the less is better. You really only need one card in addition to maybe, one other if you have foreign travel or something like that. So I think one mistake we make is we get the 10% off at the department store to get a new credit card, and then we forget about it. And
No, I don't do that.
that's
Yep.
Well, you're in good shape,
You're in
John.
good
Don't
shape.
worry
Don't,
about it.
don't lose any sleep, but appreciate the call.
Yes, thank you.
you,
Have a
John.
good
Absolutely.
weekend.
You want John's line? It's 844-220-0965. That's 844-220-0965. Yeah, you hear that? Anything past 750 doesn't matter. 751 and 810 are the same. Pretty much the same
Yes,
thing.
yes.
Yep.
Yeah. It sounds like a little competition going on.
Yes, I think so too. We have that in my family.
But he's right. They just raise your credit,
Yeah.
and it's like, well, you raised my credit score went down.
Yeah, that's what
whatever.
happened.
Ellie in Orlando, you're up next. Ellie, you're on the Certified Financial Group.
You know, it's also it's how
Okay,
often
hang on, Ellie.
how often your credit is checked too impacts your.
Yes.
Well, that,
impacts
yes,
your
that's
score.
true.
So
yes.
he's getting his credit checked every week to see how he's
Competition,
doing.
right?
Yeah, exactly.
Well, if you go to like free credit score, but sometimes credit card companies just
Yes.
offer the screen. You don't have to actually go and make a small thing or whatever. But
All right.
Ellie in Orlando, now
Good
we're
morning,
all right.
Ellie.
Now we're good.
What's up?
Good morning.
Good morning.
I wanted to ask, I've got $50,000 that I want to invest. I'm 58 years old. I have no other investments, and I wanted to know how to invest it best for growth, but also for security.
You want this thing that everybody else wants. You
Yes.
want high returns and no risk. Is that right, Ellie?
Well, I know there's no such animal.
Aha, okay.
good.
Well, we're
All
making
right.
progress. All right.
So let me ask you this, Ellie. You mentioned that you had 50,000 and that was your only asset right now. Do you have an emergency fund in case something happened to work or you became disabled?
No, I don't.
Okay, so the first thing I would want you to do is look at the disability offered maybe by your employer, or maybe you have an individual policy. And if you have, say, a 3-month waiting period before your disability insurance kicks in, you might want to consider having 3 months of your expenses put aside in an emergency fund and then only invest the excess. So we generally say
Okay.
3 to 6 months. I kind of prefer 6 months, but it really depends on your situation.
It depends on your. Well, first of all, we're assuming you're the primary breadwinner in your household.
I'm the only one.
You're the only. You are the
Okay.
primary.
All right. So we want to protect you from a rainy day. So let's say that your monthly expenses, just as an example, were $5,000. We'd only want you to invest $35,000 on a long-term basis. And because of your age, I think a growth-oriented mutual fund would be appropriate. However, what do we do when we have somebody come in, Joe?
Well, first thing we look at is what their goals are, and their
That's right.
short-term and long-term goals are. Which brings me to my next question, or my first question, is: do you have a retirement plan through your employer?
No, I don't. I'm self-employed.
Yourself? Oh, okay.
That's
Well,
why
then you can create your own retirement plan. So you have some options here, right, Gary? So
Yes.
you can turn that $35,000 that you'll have left after your emergency fund into tax deductions for you.
Right. So let's say.
That's what I was looking at.
Yeah, so let's say your business earned a profit. Again, we'll use a $50,000 figure. You could set up several different types of plans. One, it would be a SEP, might be appropriate. For a self-employed person, you can put away about 20%. Depending on how much you're able to put away, a simple IRA, you can actually put away up to $12,500. And I think you said you were over 55, Ellie?
Yes.
Okay, so you can actually put away an extra $3,000 or $15,500 into a simple IRA, in addition to the
A Unikay.
65. Yeah,
Or she could do a Unikay.
yeah,
One
right.
person 401k. And the good news for you, if you haven't done anything yet, if you haven't filed your taxes yet for 2017, you can set up a SEP. You're still eligible to do that,
Right.
get a tax deduction for 2017. And even if you have, it might make sense to file an amended return and go back and do that. So those are some options for you. But then once you have that set up, you put the money in, you get a tax deduction for it, and then what you want to look at is growth, and you want to use a mutual fund. That's the best way to get the growth.
Right,
for the
and what I
long
was going to say, Joe, that one of the things we would have somebody do is fill out an investment questionnaire, which lets us assess your risk tolerance. Now, if you were in your 50s and you came out to be conservative, we might then try to educate you on why you want to be a little bit more aggressive for the long term, because you potentially have 40 years that you need this money to grow and to provide an income for. So, but anyway, we would assess your risk tolerance, and then we would develop a portfolio for you that would suit that risk tolerance.
Does that help you, Ellie?
Yes, it does. Thank you so much.
We appreciate your call.
Thank
All right,
you.
thanks, Ellie.
All right, appreciate the call, Ellie. If you want Ellie's line, it's 844-220-0965. That is 844-220-0965. We also have the text machine up and running as well, 21232. We are playing tomorrow
Today.
with a certified financial group. Time to get the three big things you need to know.
5, 6, 7.
Welcome back to On the Money with a certified financial group right here on News 96.5 WDBO. We are 3 minutes away from the latest news, weather, and traffic here on News 96.5 WDBO. In the meantime, we're looking to take your phone calls at 844-220-0965. At Central Florida, you've got questions this morning, so I want to get back to our busy phone lines. Joe, David, Josh. We'll go to George here first. I also see we have some text questions. Hang on in case, because this is a short segment because we're 3 minutes away from the latest news, weather, and traffic, so hang on. We will get everybody's question answered. But let's kick it off with George in Orlando. George, you're on with the Certified Financial Group. Go ahead, George.
Morning, George.
Good morning.
Good morning. I have a variable premium annuity that qualifies as an IRA, and I'm 72, so I've already done the required minimum distributions. But in any other case, if you need money in between then and the next RMD, if you need money, then they charge you like an interest or a premium or something for taking your own money out. Is that true?
Well, George, it's going to depend on how long you've had that annuity. So
A long time.
a long time, then I don't think you should be beyond any type of extra charges. So typically, annuities will have surrender charge periods, but if you've had it a long time and you need more money, George, just call them up and verify.
You know what it might be impacting?
What's that?
Is guaranteed income. Because if you start exceeding the amount that they tell you to take out, you blow up the guaranteed minimum income.
George,
That could
do you
be.
have that feature on your policy?
Where they guarantee you so much income for your lifetime.
I'm not sure.
That may be
That
what's
could
going
be
on.
it. That could be it. So talk to the company directly. Ask them what the impact would be if you were to take out more money and what the fees would be by doing that.
But on some of those policies, if you withdraw more than your the guarantee amount, then you blow up the guarantee. So you
Right.
got to be careful on that, George. That's exactly what it might be. But I appreciate the call as always. Thank you very much.
All righty, George. We've got roughly 50 seconds.
50
so we're not going
seconds.
to. David, Josh, Deborah, hang on the line. You'll be first up when we come back from the latest news, weather, and traffic right here on News 96.5 WDBO. Also, we have a text question in 58 and looking to retire but don't have health insurance. What options do I have to receive health insurance, Roth, 401k? We'll get that on the other side. So text or hang in there right here on News 96.5 WDBO. Hey, welcome back. This is On the Money with a Certified Financial Group right here on News 96.5 WDBO. It's all part of our Ask the Experts weekend here. Each and every weekend, all the experts take time out of their busy weekend schedule to come in and answer your questions at 844-220-0965. In this hour, we have the Certified Financial Group, the Oracle of Orlando, Joe Burt, alongside Gary Abley. Joe, just real briefly, for anybody that may have joined us during the latest news, weather, and traffic, what can they call you about today?
Well, first of all, this is the only radio call-in show, financial radio call-in show in Central Florida, hosted exclusively by certified financial planner professionals. Gary and I are one of those, two of those, whatever you might say, and we have 11 others that are firm and up in Altamont Springs. We are here to take the questions that you might have regarding your personal finances as we go through life, trying some of this, trying some of that, and hope it all works out, only to find out we have a collection of financial accidents. So we are your financial body shop. We'd bring out the Bondo here this morning and patch it up and get you on the way. There's no question that may be a dumb question. We are here to help you and help our listeners. And the good news for you, there's still a couple of lines open, so all you have to do is pick up the phone and dial these magic numbers.
844-220-0965, 844-220-0965. We have the text questions up and running as well, 21232. And go ahead, Joe. Well, how else can they watch us today?
Well, we are trying something new here. We're now on Facebook Live, so if you have a Facebook account, go to Facebook in the search engine there, put in Certified Financial Group. And you appear right here in the studios, and you see, that's peer, not appear. You won't appear unless you have the camera reverse. That might happen.
Peer into the show.
Into the studio and see Gary and me and how we do it right here behind the scenes. So we welcome you to do that. Once again, go to Facebook.com, type Certified Financial Group in the search bar, and there we are.
All right, just like that. And again, 21232 is the text line. We do have a text question here. 58 and looking to retire but don't have health insurance. What options do I have to receive health insurance? She has 150K in the Roth, or he has. 401K is 120K.
So interestingly, the amounts in retirement accounts do not affect, of course, your ability to get health insurance on the exchange.
Right.
And
Some people think because I have so much money, I
Right,
won't qualify for a
right.
subsidy. You could be a gazillionaire.
That's a problem. So unfortunately, the Affordable Care Act did not make the health insurance, the subsidies that folks can get on the exchange, asset tested. They just made it income tested. So we have clients who have a high net worth, and they qualify sometimes for free health insurance despite having a high net worth. And of course, that wasn't the intent of the law, but that is the law. So the Affordable Care Act is one option. Individual health policies, there are not a lot of carriers that offer these. Blue Cross would be, one in town that someone could look into. But in general, going on to healthcare.gov, and you're going to have to answer a lot of questions regarding your income and so forth for eligibility for the subsidy. You want to be careful still about buying temporary policies.
These are new ones that have just been approved. Some
Yes.
coming out.
There are.
Gap insurance, they call
Gap
it.
insurance, right. So if you knew that you would only have a short-term gap, these gap policies, in between jobs would be appropriate instead of paying very large COBRA premiums. But in general, you want to make sure that you're sticking with a policy that has what's called creditable coverage, because if you don't, you could have issues then getting back onto a true either group policy or an exchange-approved policy. So the temporary policies don't cover everything. So they can exclude coverages that are mandated by the Affordable Care Act. So there is some risk to those.
Right.
So
Unfortunately, this is a challenge that we have. We do
It's a
financial
huge
planning
challenge.
for clients that
Yes.
retire before age 65. You know what your expenses are. You can pretty much know what you spend on gasoline, groceries, dining out, and all that stuff. But the real wild card is medical insurance.
Yeah, medical insurance,
Right.
too.
And so we plug that in, and then you don't know what's going to happen next year. It's
That's
a real
right.
challenge.
Medical
So-
bills, period.
Yeah,
And
this
so-
particular individual has, $250,000 in retirement accounts on the text again, but has no health insurance.
Right.
And that, of course, is a huge risk.
Yes.
If you have a heart attack, you'll be seen in the emergency room, but if you need chemotherapy for an ongoing cancer, you're not going to get free
Nope.
chemotherapy.
No.
So
Yeah.
it's a huge risk that one should not take.
Yep.
So,
Okay. All right. Well, just like that. That's how we get our questions answered here on the text line, 21232. But let's get back to our busy phone lines first. We have two Davids online. First, David is in Palm Bay. David, go ahead. You're on the Certified Financial Group.
Good morning, David.
Good morning.
good morning.
How can we help you?
I'm about ready to close on a second home, and I'm going to get about $200,000. I have a primary resident with about $70,000 mortgage and a 10-acre piece of property that I'd like to develop in Tennessee that has about a $20,000 mortgage on it. I'm thinking that for tax liability purposes, it would be better to pay off both of my mortgages before I start investing that money because of tax liability.
Well, the paying off the mortgages isn't going to affect your tax liability, David. But you may, there
On
may
the
be.
sale?
Yeah, well, now you'll have taxes on the sale regardless of whether you pay off other mortgages. So the first thing to do is to calculate what the tax effect will be from the sale. And I tell you what, I have a lot of people who they make decisions based upon an expected tax bill that turns out to be not much, right? Because we're talking about long-term capital gains, typically on the sale of real estate, and we forget sometimes how much money we've added to these properties over the years, right? Improvements can be added to what you paid for it to reduce your gain. So the first thing, David, is calculate the gain, then project your taxes. Another thing a lot of folks don't know, Joe, is that your tax rate, your long-term capital gains tax rate for the lowest bracket is actually a big zero, right? So there are some folks who end up having a small long-term capital gain and they end up not paying any taxes on it. So first thing is find out what the taxes are. Then you know what you're going to net from the sales. So let's just hypothetically say you sell it for $200,000 and you.
Now, do we have $200,000 of profit? That's the other thing we're talking about. You say you're going to sell it for $200,000?
No, it's $300,000 $399,000 minus the equity loan that I have on the property currently, leaving about $220,000.
And what did you pay for it?
My dad and I were co-owners. When he passed on, I got right of survivorship. The tax liability, as far as taxes, have been around $225, $250 on the property.
Now, you're talking about
You're
property
talking
tax.
about property tax, yeah, assessed
Yeah.
value. So what we would want to know is what your father originally paid for the property, and how you received
Well,
it. If you
we built on a 10-acre property, had 2 houses, had to subdivide it out. It's really very complicated.
It is complicated. Joe and I are like shrugging.
Yeah.
So the key thing is you need to sit down and figure out what your basis, which is your cost factor in the property is. So for those listening, if you inherit property, there's a step up in basis to fair market value. Now, if you inherited half of it because you owned a joint, half of the property potentially could receive a step up. So yours is complicated. Without trying to calculate it on the air, I would suggest you sit down with a CPA, find out what the gain is, find out what the tax is on the gain, and then out of that $200,000, let's say hypothetically you have $20,000 in taxes, you know you have $180,000, then I think you say, I've got a bucket of money of $180,000. Now, is it prudent to pay off debt that you have on other properties? And that is really going to be based on how much you owe. What type of an investor are you? Are you conservative and you would prefer to be debt-free? Or are you needing to pay off the debt because you need to do a new loan because you want to develop this new piece of property and they won't do it until you pay off an existing lien on the property?
And
so there's a lot of questions.
And if you're in the tail end of the mortgage, it might not make sense to pay off the mortgage at all, because in the tail end of a mortgage, you're
Right.
just paying back your own principal. It's really
right.
not costing you a lot. So there's a lot of variables.
Yeah, this
in
is a
entering-
sit-down
yes, this
type
is-
of
yeah,
question.
This is something that Gary and I deal with all the time as certified financial planners. But the first step is, as Gary said, is to get a good idea on your taxes. Based on what you said, you bought this land, then you developed it, which
Right.
means you've got some sunk costs in there in developing that property. So your
Right.
taxes may not be nearly what you think they are.
That's right.
David, I wish I could give you a quick answer, but you bring up a lot of questions that need to be answered across the desk. But we appreciate the call and wish you
Thank
well.
David.
Well, we have got the number so David can give you a call on Monday.
Our number is 407-869-9800.
Or go to our website, financialgroup.com. That's financialgroup.com.
Financialgroup.com. Such a great website, too.
Yep.
Josh in Orlando, you're up next. Josh, go ahead. You're on the Certified
Josh.
Financial Group.
Good morning. Good morning. I just wanted to ask a question. I work for an employer who has a very generous deferred compensation plan. Previously, we've been offered stock options, and we've always just automatically. This year, it's changing, and it's going to an option of continuing with stock options or RSUs. So my question is, I'm relatively young. I'm in my mid-30s. Would it be better to take an RSU option from my company, still the same value and everything, and then as those vest, diversify in like a mutual fund so it's not all invested in one company?
Well, boy, I like your thinking. So I like whenever I hear diversify, because sometimes, we end up with a lot of company stock with an employer that we work for, and then something bad happens. I have personal experience with that in my own family, where my wife had worked for Columbia Healthcare and had stock options, and of course, what happened with Columbia Healthcare, Medicare fraud, the stock plummeted, and those stock options became worthless overnight.
Look at the people that work for GE.
Well, that's right. Look at the folks who work for Enron and WorldCom, and we could go on and on. So the idea of selling when they're vested and diversifying, I love that idea, Josh. Now, restricted stock unit, the advantage of that maybe over a stock option is stock options have strike prices, right? And a restricted stock unit is you just are giving the ability to buy company stock. So you can somewhat ride out a storm. So, for example, in the Columbia Healthcare example, the company did rebound eventually. So if you owned the stock, you were able to recover. But if you owned the stock options, those became worthless because they expired with time. So in this example, if we're comparing apples to apples, and it's very hard to do that, frankly, when you're comparing a restricted stock unit and a stock option. But assuming both offers appeared about the same financially, I would favor the stock unit. How about you, Joe?
Yeah, I think so.
Yeah.
For the reasons you said.
Yep, and then as soon as as soon as you're completely vested in it, as long as you have more than, say, 5% tied up in your net worth, I would say sell to diversify. What's the number you use, Joe? I use 5%, no more than one company.
Yeah, and the thing, as we said time and time again, the challenge that people have when they have the ability to get stock in their company is they buy that stock for the wrong reasons.
Yes.
You know, they think that the boss knows how much they own and it's a part of loyalty.
Right, yes.
Or you think you really know what's going on in the company, and you wake up one day and you find out what you thought was going on really isn't going on. And so it's because you're close to it. You know,
Right.
you eat, breathe, and deal with
it's
it
an
every day.
emotional attachment.
Yes,
Yep,
and
it's an
yes, so
emotional
5% is really about the limit that you want to do.
Yep.
And what we don't want you to do is to do that at the expense of maximizing your contribution to your 401k plan. Do you have a 401k, Josh?
Yes, I do.
Okay, and how old are you?
I'm 35.
Okay, so you can put 18.5 into your 401k. Hopefully you're doing that and investing that aggressively at your particular age. And then I would look at getting company stock. What do you think,
Yes,
Gary?
absolutely.
Appreciate the call, Josh.
Thanks, Josh.
Thank you.
Diversify is the name of the game. That's what I've
Absolutely.
learned here
Yes.
on the money. Diversify is the name of the game. All right, let's go to David in Davenport. David, you're up next. The Certified Financial Group. Go ahead.
Morning, David.
Hi, can you hear me? My phone's breaking up.
We can hear you. What's up?
Okay, my credit score has been forever 500 and something. I've been married 48 years. 45 years ago, I filed for bankruptcy. Ever since then, I've been paying cash for everything, but I do have credit with Rent-A-Center Gold Card with them in 3 different states. I do have credit with a Goodyear tire company mechanical shop. All my bills, water, electric, rent, everything, I paid 2 weeks early. And I applied to get a used camper, and they told me that because of my car accidents, that I don't qualify. I've never had car accidents.
Well, then you need to check that out. I would contact the credit
But
bureau.
that's
to
an
find out what's going
interesting
on.
that's an interesting point, David. A lot of people don't realize that decisions are going to be made on loaning you money, not just on your ability to pay, but on really, we're going to try to analyze the type of person you are. Because if, let's say you have a lot of moving violations, car wrecks or whatever we want to say, that could indicate, and I'm not saying this about you, David, but it could indicate a riskier personality, somebody who's constantly getting speeding tickets, and therefore one can argue you could make riskier decisions in your financial life, and therefore they can charge you more based upon even your driving record.
You know, something doesn't sound right here, though, Dave.
No.
What threw me off here is when you said you have this credit, but you don't use it, and therein lies the problem. If you don't have a credit, the biggest thing that affects your credit score is timeliness of payments.
Right.
That's the number one biggest factor that affects your credit score. So if you're not making regular payments, forget the water bill.
Right.
It's the credit cards.
Right.
Yes.
You're using cash for everything.
Exactly.
You mentioned, David,
Yes.
and if you're paying cash for everything, that is part of the problem. I mean,
Yeah.
you did mention you have two companies.
Hi, please. I was approved last month for a medium-sized car, brand new. I don't want the payments. I have a vehicle.
I understand, but therein lies the problem. If you want to increase your credit score, make payments.
Yeah, make payments. Yeah.
That's right.
Well,
it's a
And making
dangerous thing.
payments in cash
Yes.
doesn't seem to count anymore.
Yes.
Right.
Yep. Yeah. That's the challenge. So, but I'm not saying if you should do the tire store, because chances are that interest rate that they may charge is going to be high. Get a low interest rate credit card and use it on a regular basis and pay it off every month. That'll affect your credit score more than anything.
All right, David. Yeah, thank you so much for the phone call. We're up against the 3 big things you need to know. Paying in the water bill in cash 2 weeks early doesn't get you anything
doesn't
anymore,
get you nada.
unfortunately.
Zippo.
Yeah, unfortunately. David, thanks so much for the phone call. 844-220-0965, 844-220-0965, or you can text us your question to 21232. We are planning tomorrow
Today.
with the Oracle of Orlando. Joe Burton, Gary Abley with Certified Financial Group on News 96.5 WDBO. away from the latest news, weather, and traffic, but you are listening to the final segment of the On the Money with a certified financial group here on News 96.5 WDBO. You know, when you do 4 of these shows every Saturday and it's around the same thing and you didn't finish your coffee yet, they all just merge together after a while.
We still love you.
Yes, but this is the certified. This is my favorite show. I will say this. Don't tell anybody in the hallway listening right now. This is no doubt my favorite show to do. There's no question about that. Joe Bird to the Oracle of Orlando, Gary Abley are here answering your questions. 21232 on the text line. Just keep it to about 160 characters. But not only do they come in here in the studio each and every week to talk to you here in Central Florida, they also welcome you to their house. It's called The Workshops.
That's
Gary,
right.
when can I come by later this week or this
Well,
month?
so we do several workshops. We'll talk about just the types we do. We do them on healthcare options and retirement. Unfortunately, that one's booked up, and we'll be doing another one probably in another 4 or 5 months. So check our website, financialgroup.com. We do one on financial basics for life. So that's the next one that's not full, and that is September 8th at 9 o'clock in the morning, so from 9 to 11. And
That's a Saturday?
they're all Saturdays.
All Saturdays.
Saturday mornings. And the appropriate party for that is anybody who has not learned financial basics. Now, that's quite a bit of people.
That's
95% of America.
But it's
yes.
really geared for younger people who want to understand how they can get to $1 million before they start college without ever saving another dollar. So we teach them how to do that. We teach compounding of money. And that's, by the way, only working 6 summers, 30 hours a week.
Actually, he teaches them how to pick lottery winners.
No, I do not. No, I do. We've all won the lottery already. You know
The
what I
horse
think about
track,
that.
you know.
All right, so October 6th, countdown to retirement. So we're going to talk about things like tax strategies in retirement, Social Security claiming strategies in retirement, what you need to do to make sure, legal documents you need to have in order prior to retiring. So that's a great one that's designed for people who are, say 3 to 5 years away from retirement. And then my favorite one is December 1st, will your savings last a lifetime? And the reason that's my favorite is that's our biggest fear, right, is running out of money.
Right.
And we don't want our clients to retire without first knowing that at least they have an 80% probability of not running out of money based on the savings they've accumulated.
Yep.
So that's a really important one, I think.
When we
can
do
all
financial
benefit.
planning, as Gary said, we stress test.
Yes.
We stress test the end result to be sure there's a high probability of you're going to be. We can't guarantee anything,
Right.
but we run it through 10,000 different iterations at all possible variables to look at the possibility of you being okay.
Okay.
And that's important because numbers are not static.
My goal is to plan to be 100 years old, and anything after that, I don't care.
There you go.
That's my plan. That is my plan, and I am sticking to
Nothing
it.
wrong with that plan.
All right, we got a minute left. What's the best number to reach you guys at the office and the website?
Our website is financialgroup.com, and our phone number is 407-869-9800.
All right.
So
Then.
you can learn all about us. Go to that website. There's a little quiz on there, a little survey. You can find out where you might stand, and we'll be glad to talk to you. We offer a complimentary visitation. You want to come by, give you a cup of coffee, find out what's on your mind, see if we can help you. If we can't help you, we'll point you in the right direction. It's what we've been doing for nearly 40 years as Certified Financial Group. We have 11 certified financial planners. We are CFEX certified, and if you want to learn more about that, go to our website, financialgroup.com. We are one of the few firms in the country that is CFEX certified for fiduciary excellence. We are fiduciaries who work with our clients doing financial planning for a fee and wealth management. So come on by our website, come on by our office. We look forward to meeting you, and we look forward to seeing you again next Saturday.
1111 Douglas Avenue, right?
Yep,
Yes, that's it.
1111 Douglas Avenue. Put it in your phone, and we'll see you there. We'll play it next year on the radio, 9 o'clock Saturday, with a Certified Financial Group. We will continue playing tomorrow.
Today.
This is News